This bold move has sparked intense debate among economists and politicians alike. In this article, we will delve into the details of this proposal and explore its potential implications. The proposal, tariffs as a replacement for income tax. President Trump has proposed replacing the income tax with tariffs, a move that has been met with skepticism by many experts. The idea is to impose tariffs on imported goods and use the revenue generated to fund government spending. This approach is based on the principle that tariffs are a more efficient way to raise revenue than income tax, as they are less burdensome on businesses and individuals. The main argument in favor of this proposal is that tariffs can be more effective in raising revenue than income tax. By imposing tariffs on imported goods, the government can capture a larger share of the value added to those goods, rather than relying on a flat tax rate on income. Another argument is that tariffs can be used to level the playing field for American businesses. By imposing tariffs on imported goods, the government can protect American industries from unfair competition and ensure that they have a fair chance to compete in the global market. The potential implications. The proposal to replace income tax with tariffs has significant implications for the economy and society as a whole. Some of the potential implications include increased costs for consumers. Tariffs can increase the cost of imported goods, which can be passed on to consumers. This can lead to higher prices and reduced consumer spending. In 1960, he paid 6.4% in federal taxes. In 1961, he paid 7.2% in federal taxes. In 1962, he paid 7.7% of his income in federal taxes. In 1963, he paid 8.1% in federal taxes. In 1964, he paid 8.4% of his income in federal taxes. The child tax credit was a significant change to the tax code, as it provided a direct payment to families with children, rather than a deduction that could be claimed by taxpayers. The impact of the child tax credit on families. The introduction of the child tax credit in 1997 had a profound impact on families with children. The credit provided a direct payment to families, which could be used to offset the costs of raising children. This was a significant change from the previous deduction, which required taxpayers to claim the credit themselves. The child tax credit was a game changer for low-income families, who often struggled to make ends meet. It provided a safety net for families who were struggling to pay for childcare, education, and other expenses related to raising children. The credit also helped to reduce the financial burden on families who were raising children with disabilities or special needs. The benefits of the child tax credit. The child tax credit had several benefits for families. Some of the key benefits include increased financial stability. The child tax credit provided a direct payment to families, which could be used to offset the costs of raising children. Reduced financial burden. The credit helped to reduce the financial burden on families who were struggling to pay for childcare, education, and other expenses related to raising children. Improved financial security. The child tax credit provided families with a sense of financial security, knowing that they had a safety net to fall back on. The challenges of the child tax credit. The challenges of the child tax credit. While the child tax credit had many benefits, it also had some challenges. Some of the key challenges include complexity. The child tax credit was a complex program, with many different rules and regulations. The tax credit for children. A proposal to boost family support. The tax credit for children is a vital component of the U.S. tax system, providing financial assistance to families with dependent children. As the U.S. government considers various proposals to boost family support, a significant change to the tax credit for children has been suggested. In this article, we will delve into the details of this proposal and explore its potential. Impact on families. The current tax credit system. The current tax credit system provides a tax credit of up to $2,000 per child, with a phase-out threshold of $400,000 for joint filers and $200,000 for single filers. This credit is designed to help families offset the costs associated with raising children, such as childcare expenses, education costs, and other family-related expenses. The proposed increase as an aside, Vice President J.D. Vance is suggesting an increase to the tax credit for each child to $5,000. This proposal aims to provide more substantial financial support to families, particularly those with lower incomes. By increasing the tax credit, the government hopes to alleviate some of the financial burdens associated with raising children. The proposed increase would result in a significant reduction in the number of families who rely on government assistance programs, such as food stamps and Medicaid. The increased tax credit would also lead to a decrease in the number of families who struggle to make ends meet, as they would have more disposable income to allocate towards other expenses. This is a staggering amount, especially considering that the top 1% of earners in the United States make significantly less than this amount. The FICA tax rate is 7.65% of the employee's income, which is split between the employee and the employer. Understanding FICA taxes. FICA stands for Federal Insurance Contributions Act, which is a federal law that requires employers and employees to contribute to a Social Security and Medicare program. This tax is used to fund Social Security and Medicare benefits for workers and their families. How FICA taxes are calculated. The FICA tax is calculated based on the employee's income, and it is typically withheld from the employee's paycheck. The Tax Cuts and Jobs Act, TCJA, reduced the number of pages to 2,190 pages, a reduction of 14,810 pages. The evolution of the Federal Tax Code. The Federal Tax Code has undergone significant changes over the years, with the most recent overhaul being the Tax Cuts and Jobs Act, TCJA, of 2017.